You made a lot of important points, in fact, about what's going on in China today. Let's start there, because the implications of a slowdown in China and the implications of what China does with all of the debt that it holds of the United States' debt in the bond market have real implications on markets. Give us your assessment.
China's going through two drags on its economy over the short term, and that is it's dealing with a deleveraging. Deleveraging is a good thing. In other words, it's controlling and it's restructuring its debt. That slows demand some. That's a factor. And then the other short-term negative is the conflict with the United States, particularly as it pertains to debt. It went from a bit of a bubble to this particular adjustment. Longer term, it's making big reforms. It's continued to make dramatic reforms in ways that have, over the last 40 years, have raised its living standards by 20%, 20 times. And so if you look at the longer-term productivity movements, very, very good. Opening it up. So I think that people have got to realize it's going to be a negative, all things, on growth. Europe has a negative growth, and the United States is going to have a negative growth environment. I don't mean absolute negative. I mean slowing of growth in a material way that could be close to between 0 and 2% over the next 18 months. So we are going to be in a slower growth environment, and then, of course, that affects capital flows. In terms of then the issue that we have capital flows, we have to remember that the other side of a trade deficit is a capital deficit. In other words, they bought our goods, and then at the same time they lent us a lot of money. And I think we should always be mindful that capital issues, capital flows, have a very big effect on the world and the economy, because they can change things a lot. And so I'm not saying that the Chinese are going to react by changing that, but I do think they will change the mixes of their assets that they're holding, and I think that has implications. I think it particularly has implications as we're going for the next year or two or three, when we have to sell a lot of U.S. dollar-denominated debt, because we will have larger deficits as a result of the corporate tax cuts. And as a result, we're going to have to sell an enormous amount of corporate debt into world markets. And so that will be a pressure on those world markets. And we have to think about who are the recipients of that. And those capital flows will be a big deal.
Yeah, I think you make a really important point. Now, the regulator that we just spoke with, Dr. Fang, who was on our panel, said, look, the U.S. bond market has been a good place to invest. We're not looking to change that very much. But this is something to watch, given just the sheer size of debt that the U.S. is going to be selling.
Right, and I think that, I think that there are diplomatic ways of saying that thing. If you were to say, are you going to buy the same amount of bonds that you bought in the past, or what is the best asset allocation, or could it become politicized? I think those are the more delicate questions that really haven't been adequately explored.